All right, now the first topic I'd like to discuss is the precious metal markets, because one of your colleagues at goldmoney.com recently wrote an article that talked about why silver seems to be its positioning for a breakout. Can you expand on, do you believe this, and can you expand on why?
Yes, I think you're referring to an article, I think, by Stephen Wheeler, and right. I would agree with his supposition. The precious metals, I think, as a whole, are on the verge of breakout. As far as silver is concerned, it has become very, very oversold. Now, this to me is a bit of a mystery as to why people should short silver and remain short of silver on the view that it's going lower. I can only think that this is hedge funds thinking that the global economy is going to nosedive and there is going to be diminishing demand for base metals, to which silver is probably more tied nowadays than gold, in this current environment anyway. However, I think it's only a matter of time before gold breaks out above the sort of, I suppose, this sort of trading range we've had recently, the upper end of which is around about $13.60, $13.65. Once we break out of that, I would expect silver to move like like grease lightning, if you like, because always it is, if you like, the poor man's money. It's the poor man's metallic money, as it were. The rich people go for gold all around the world. The people who can't afford gold, in inverted commas, go for silver. So the volatility, I think, historically has been a move in the price of silver equates to something just a little less than twice the move in gold. So if gold goes up 5%, silver goes up, say, 9%. That is the sort of the order of the move. And because I do expect gold to break out, I do expect after this current rally in the dollar for the dollar to weaken. I can see gold going quite a lot higher over the rest of this year. And under those circumstances, I think that silver would be a very, very good thing to own.
No, you're saying gold could go quite a lot higher. What exactly, do you have a price target?
No, I never ever have price targets because they're completely meaningless. Nobody knows what tomorrow's price will be. What we do know, however, are the dynamics behind the market. And at the moment, the dollar is strong, and that is leading to weak gold. This is because people buy a strong dollar by shorting gold. It's as simple as that. This is the business in the futures market. It's not the physical market. It's the futures market that puts this link into place. I would personally expect to see President Trump's economic policies begin to undermine the dollar later on this year. And I don't think it'll be very much later this year before this happens. Now, the reason that this is going to be the case is that you've got two drivers that you look at in terms of currency relationships. The one thing which is obvious and everybody talks about is interest rate differentials. And at the moment, the interest rates on US Treasuries are higher than they are on, if you like, the European government securities denominated in the euro. And in some cases, it's quite a lot higher. So you can see that is an attraction. That is an attraction for people to hold dollars relative to euros. But the other thing that is very important is the trade situation. Inevitably, the result of this increase in the budget deficit that President Trump is bringing about will lead to an increase in the trade deficit. And it doesn't matter what trade tariffs or anything else he puts in. It is, if you like, an accounting identity that is what happens. So what we will get is we will get evidence of a deteriorating balance of trade for America. And I think at that stage, people will begin selling the dollar quite heavily. The other side of that, of course, is that if you want to short the dollar, you buy gold. If you take that one step further and you're worried about the outlook for the dollar because the Fed can't raise interest rates by very much without bringing the whole caboodle down because of this massive, massive quantity of debt overhanging everything, then you've really got the sort of stagflationary nightmare, if you like, whereby they can't raise the interest rates because it's screwing the economy. The nominal rates are screwing the debt side. The economy is going nowhere. They can't actually attack inflation because they would bring about a credit crisis if they did so. Now, this is going to be the big, big dilemma that I think people are going to become increasingly aware of when it comes to the dollar over the course of this year. Now, that dilemma was precisely the situation we saw in the 1970s, before this run-up, if you like, to the Volcker appointment. And it was Paul Volcker who raised the prime rate in those days. It was the prime rate that everybody followed, up to 20.5% to kill the inflationary expectations. Now, in those days, what that did was it wiped out the savings and loan business, which, it was all sort of picked up and so on. What are they going to do this time? You don't really have the option to go down the Volcker route to kill inflation because of this massive quantity of debt. And not only that, but if you go to push up interest rates in the dollar, then you're going to create the crisis. And we're already seeing the strains in emerging markets because those currencies have done exactly the same thing. I'm not including China in the emerging markets in this sense, but if you look at some of the emerging markets around Latin America, and we've seen the problems coming up in the Argentine, I would also suggest that some of the Southeast Asian countries have been too profligate, if you like, in their currency production. And so you can see that there is this danger, if you like, of a fiat currency problem coming up, which because nobody will be able to tackle the inflationary consequences of earlier monetary stimulus. And under those circumstances, the dollar will go down, gold will go up. That's what happened in the 70s. I see it happening again.
Now, one of the kind of solutions a central bank could implement is just, raise the inflation target. And it seems like you commented on this about how Canada seems to be doing this.
Well, they're not doing it yet, but what we have seen is that some of the Bank of Canada's economists have written an article which they published at the Bank of International Settlements website, suggesting that one solution to the current problem, because central banks are worried, they've got no room, really. They would like to have interest rates a bit higher, but they don't know how they can do that without creating a credit crisis. They expect a credit crisis will occur at some stage, and so therefore they need the room to be able to lower interest rates in order to respond to that credit crisis. Now, one of the things that these Canadian economists were looking at was, well, what happens if we raise the target rate of inflation? Will that give us more headroom with this problem? And the whole thing is actually laughable. It's all based on the idea that you need inflation to stimulate an economy. Now, if that was true, then 4% would be better than 2%. 100% would be better than 4%. It's just not true. We don't go out into the supermarket, say, and buy things because they are more expensive. No, we look for the bargains. I don't know, how it is that economists have got this idea in their head that you've got to continue to drive up prices in order to create demand. You don't. Actually, what they're doing is they're driving up prices to lower or reduce the cost of labor. That is actually what they're trying to do, and they're being entirely dishonest about it. And they now have the problem that inflation is running out of control. So what do? Well, let's see if we can change the targets. That's going to give us a little bit more of a leeway. And I suspect that this work is a bad word for it. If this suggestion from the Bank of Canada's economists gets more traction, I can see that other central banks are going to also explore the possibility. And this also is one reason why they're really pushing the possibility of doing away with cash altogether, because the other way to do it is to put in negative interest rates so deeply negative that, from their sort of straight line graph, they can say, well, if we reduced interest rates to stimulate the economy and get inflation back up, then if we can, if we're not bound by the lower bound and we can actually push inflation way below the lower bound, then surely that's going to be a good thing. It's not. It's a tax on deposits. But anyway, that's another subject.
You discussed a little bit about Trump's trade conflicts right now, and you also wrote an article about this, how really the debates about Brexit and Trump's trade conflicts and stuff really demonstrate that no one really has a good grasp of comparative advantage. Now, you learn about comparative advantage in, the first economics classes you take. Can you tell us a little bit about this and why it seems like nobody is understanding this?
Well, as to why nobody's understanding it, I honestly don't really have an answer to that question. But just comparative advantage is very, very simple. I write on economics. That is what I do. I don't go and make my own shoes. No, I go and buy my shoes because someone else makes them a lot more cheaply than I do. And not only that, but it'd be a complete waste of my time to do so. So the shoemaker has a comparative advantage over making shoes compared with me or compared with one of my friends who I could equally turn around and say, you're not doing anything at the moment. Why don't you run me up a pair of shoes? And he's going to turn around and say, I'm sorry, but I don't know how to make a pair of shoes. That is really what comparative advantage is. Now, if you accept that, it's the basis, if you like, of the division of labor. If you accept that, then, why is it that you put a limit in terms of who you actually seek this comparative advantage from? For example, I live near a town called Exeter in the west of England, southwest of England. What's to stop me, let us say, going and buying some shoes made in London? Why not? That's my choice, if I make that choice. And it could be that the shoes are cheaper, better, whatever it is. There is a comparative advantage compared with a cobbler in Exeter, if you like. So nobody worries about that. And in America, nobody worries about the fact that you might be, let's say, living in New York City and you buy things in from, say, Idaho. Or wherever. Nobody worries about that. But why is it then that we have this problem that when it comes to buying things from abroad in another country, that we're not allowed to pursue this comparative advantage? It is to everybody's economic benefit that we do so. Yet what we have instead is nationalism, and it's nationalism that stops it. So that is what President Trump is doing. He's waving the nationalist card. When it comes to Brexit, there is so much confusion in the Remain camp. It's just, it really is pathetic. On the one hand, they're trying to protect British industry. They think that the free trade area of the EU is the best way to do it. They don't seem to mention that because we're in the free trade area, we end up paying more for our goods than we would otherwise. And here again, we come up with this problem. What actually drives an economy? Is it, do people buy things because they're more expensive, or do they buy them because they're cheaper? They buy them because they're cheaper. And if you remove the tariffs, then actually what happens is that people have got more money to spend on other things. And this was precisely what happened. If we go back to the time of Robert Peel in the 1850s, when he, as Prime Minister, and it took him a little while to do it, so I've got sympathy with our current Prime Minister in this. But he removed all tariff barriers, starting with abolishing the Corn Laws and all the rest of it. And he said quite simply, why should we as people, pay more than we need for foreign goods. No reason at all. The result of that was there was an acceleration of production in the UK economy that was absolutely massive. And the UK economy was so successful because we removed all tariffs. The French did it a decade later. They became successful. But of course, protectionism starts coming back, and you've got a constant fight, if you like, against people who want the government to protect them from foreign competition. But I mean, what we've seen, New Zealand is a very good example as well, if you like, a more contemporary example. New Zealand is an agricultural economy, and they used to export an awful lot of stuff to the UK because, we were in the Commonwealth. But then when we went into the European Union, it so happened that they were unable to export to us without having to pay tariffs. So what they did was they just withdrew, if you like, from supporting their agricultural community and just let them develop markets for themselves, or reduce the amount of lamb and wool and all the rest of it that they were producing. And the result is you've now got an economy that is wholly competitive in the global sense and doing extremely well. It forced the farming community to look at alternatives. I mean, if you go out to New Zealand now, I mean, they're growing, fruit, things like avocados, the result, which I don't think ever came from there in the first place. They found these new fruit to grow. I mean, kiwis, obviously, we know that one. What they have done is they've diversified, and the result is that you've got, and the wine industry there, excellent. So you've got, out of free markets, you have a very, very diverse agricultural economy, which would never have happened if government had continued to support agriculture. And that, I think, is the big, big lesson for today.
Now, Trump's argument, though, is that, we're being cheated by other countries. For example, China manipulating their currency so that they can export more. So what is your perspective on that?
Well, it's a complete nonsense, simply because if a Chinaman comes along and offers you something at a cut price, are you going to turn around and say, that's not fair? What? It's complete nonsense. If the steel industry, for example, if there is overcapacity in China and they decide to dump steel, why shouldn't your manufacturers in America, I'm not talking about the steel industry, but I'm talking about downstream from that, the people who buy steel to make things, why shouldn't they benefit from low prices? No reason at all. But we've got nationalism, and we have got steel companies, we've got steel foundries who will lobby to restrict these foreign imports and to put tariffs on them. It's not the business of government to decide what you and I pay for our goods. It really isn't. And that is the thing that basically should be stopped.
Right. And I've also heard the argument that there's this fear, that, for example, if China keeps dumping cheap goods on the American market, that'll push the price down and cause companies to go out of business, and then China will have a monopoly on some of these products. What is your perspective on that?
Well, again, we come back to this, law of comparative advantage. Why shouldn't, why shouldn't you buy toys or whatever it is for your children made in China if it is cheaper? It's your choice as an individual. I think one of the things that is, if you like, a mistake that people make is they think that because China is manufacturing and able to sell things more cheaply to Americans than Americans can make themselves, that is the cause of the trade deficit with China. It's not the case. The reason that you have a trade deficit is actually a trade deficit with the rest of the world, and that is because of monetary policy on the one hand, the expansion of credit, and fiscal policy where your government is running a massive budget deficit. It is the balance of those things that makes up the surplus or deficit between America and the rest of the world. And it so happens that the most competitive of the countries that export to America is China. And that is why so much of the trade deficit is with China. It is because they are producing things that ordinary Americans want. But if you want to sort out the trade imbalance, then you have to look at yourselves, not at the Chinese, in order to do so.
That's really interesting. It's so often, as you talk about that, it's blamed on China, but really, as you're saying, the United States has to do some soul searching itself.
Yeah, absolutely. I mean, it's fascinating. I discovered the other day that the Chinese now own Volvo, which is a European car manufacturer, which has always been a bit of a premium brand, I suppose. And one of my sons bought a Volvo. He bought a top-end hybrid Volvo because the tax situation works favorably. That's another distortion the government puts in. Anyway, we'll pass over that bit. But the technology in this is absolutely staggering. Now, that is a Chinese-owned manufacturing entity exporting its cars into other countries. I mean, he bought this car because it was something that he needed for business and all the rest of it. And it's got so much artificial intelligence in it. If you're sort of reversing out of your gate, it'll tell you if there's anything coming from left or right if you can't see, because reversing, by definition, you can't see. It will, you've got a sort of bird's eye view of where you are in terms of obstacles and all the rest of it if you're trying to negotiate a small space. And not only that, but when you get on the motorway, or you call it the freeway, it'll stick to the lane discipline. The cameras show, it just steers itself. It is quite remarkable. Now, that's Chinese owned. Should we ban them, do you think? I mean, this is, let's ask ourselves this question. Why should the Chinese sell us motor cars like that?
No, yeah, it seems like if they're making better products, we should definitely buy from them.
Exactly.